Hello, Avram friends. Ever had that one friend who suddenly goes, "Bro, my stock doubled in just 3 months"? Sounds epic, right? Feels like they just unlock cheat codes to money. But here's a twist. Fast forward a few months and poof, that story vanishes. Why? Most likely the stock dropped again, and now they run the talk about literally anything else. That's the thing about investing. It's unpredictable. Sometimes it feels like you're winning big. Other times, it feels like your brain's on fire trying to process the losses. If you don't want your emotions to go up and down like a roller coaster, there's one simple move you have to know, and that is called diversification. Basically, it's a way to spread out your investment so that one bad day doesn't ruin your whole portfolio. So let's break it down. What is diversification, and how can it be the shield that protects your money? There's an old saying that still makes sense today. Don't put all your eggs in one basket. But here's the problem. So many investors forget this. They go all in on one stock or even just one sector, hoping for quick profits. The risk, if the market shakes, that one basket can drop, and boom, your whole portfolio takes the hit. Before we move on, let's break down on what diversification actually means. Diversification basically means spreading your investment instead of putting everything in just one place. It's not only about buying one stock or one sector, and definitely not just one type of asset. Take Indonesia, for example. A lot of investors love backing stocks. Fair enough, they're liquid. They often drive the ISHG. But imagine if 100% of your money was in banks. Then suddenly Bank Indonesia rolls out a new policy that squeezes the margins. Your portfolio could take a big hit overnight. If your portfolio was more diverse, say you got some consumer staples, telco, energy, plus a chunk of government bonds, then the drop wouldn't feel nearly as painful. Why? Because the other sectors help cover the losses. Here's why diversification matters. Number 1, it makes your ride smoother. Over the past 10 years, ISHG grew around 5 to 6% per year on average. But it wasn't just a straight line. Some years it jumped to 20%, after years it dropped to 15%. If you mix stocks with government bonds, which usually give a steady 6 to 7% yield, the ups and downs feel like extreme. Number 2, every sector has its own cycle. Remember 2021, coal prices shot up and coal stocks doubled. But in 2022, when prices fall, those same stocks dropped hard. Meanwhile, consumer stocks like food, drinks, and soap, they stay steady because people still shop no matter what. If you had a mix, you'd enjoy the upside of a coal without being crushed when it turned. Number 3, it protects you from surprises. During COVID pandemic, 5 years ago, property, transport, and tourism stocks tanked. But healthcare and tech stocks soared. Investors with a diversified portfolio survived better because at least part of their investment kept on growing. At Avram, diversification isn't just a theory. It's something we practice every single day. We usually split our investment into 3 different big groups. Number 1, equity stocks. Think of this like a striker on a soccer team. They can score big goals, high returns, but they also take big risk. In Indonesia, this could be banking, consumer, energy, or tech stocks. Number 2, fixed income or bonds. These are like the defenders. They don't look flashy, but they keep your portfolio steady. Government bonds usually give around 6 to 7% a year without low risk. Number 3, money market. This is your goalkeeper. Maybe not the most exciting player, but super important for protection. Returns are smaller, but it's very liquid, meaning you can use the money anytime you need a quick cash. Now, just like a soccer team can't win with only strikers, your portfolio can't rely on stocks only. You need a team: stocks for growth, bonds for stability, and money market for flexibility. That's how you build a portfolio that's strong, balanced, and ready for any game. So, diversification isn't just some magic trick to get rich quick. It's really about making sure your portfolio can survive even when the markets get shaky. Because investing is a long journey, not a sprint. With diversification, you're not just chasing profits, you're also building portfolios that's calmer, more balanced, and built to last. Mix it right, Because one trick portfolio won't stand a chance.
Thanks for watching. Jangan lupa like dan subscribe agar kamu gak ketinggalan informasi menarik lainnya. Sampai jumpa!